Good morning, everyone. My name is Sarfan Wantanagon, and I'm a student at British Columbia International School, Bangkok. Today, I'd like to share my research paper with you all. So, my title of my research paper is kind of long. It's Predicting Dividend Statuses of Thai-listed Companies Using Machine Learning. But the idea behind my paper is quite simple. I wanted to find out whether a machine learning model could learn to predict what a Thai company will do with its dividends. So would it raise it, keep the dividend steady, cut it, or keep paying nothing at all? Throughout my presentation, I'll explain why this question matters, the data I collected, the 3 machine learning models I tested, what I found, and just as important, what my results can't yet prove. So, let's get started, shall we? So, first off, what's a dividend? When a company earns a profit, it has a choice. It can either A, keep the money to grow its business, or it can B, pay part of it back to the people who owns its shares. That cash payment's called a dividend. Dividends matter because they act sort of like a signal. So when a company raises its dividend, it's telling the market, hey, we're doing well, and we expect to keep doing well. And when it cuts its dividends, investors usually get really nervous because that's usually not a really good sign. Dividends are also a puzzle. In fact, that's how economists use the word dividends. They call it the dividend puzzle. The dividend puzzle asks, why do companies pay dividends at all, and why do investors love them when classic theory says dividend policy, shouldn't even change a company's value? What we do know, however, is that dividend decisions are based on many factors at once, and they don't follow neat straight-line patterns. Messy, complicated problems, such as the dividend puzzle, are exactly where machine learning can help. So, before building anything, I reviewed 19 previous studies, and I took away 3 lessons that stood out. First, in study after study after study, machine learning outperforms traditional forecasting on that study's own data. For example, a 2024 paper by Wang and co-authors found machine learning dividend forecasts were much more accurate than methods based on analysts or payout ratios. That doesn't really mean that machine learning always will be better or will always win, but it's a strong reason to test it. Second, dividend behavior is nonlinear. Models that allow curves and sudden thresholds predict better than straight line models. And third, almost all of this evidence comes from developed or very large markets, as I said, the United States, India, South Korea, and the G7. Emerging markets like Thailand have received much less attention, and that's the gap I had hoped to fill with my paper. Now, my data. I studied 515 non-financial companies listed on the Stock Exchange of Thailand, or the SET, across 25 years, so from 2000 to 2024. The raw data came from Guru Focus and covered each company's income statement, balance sheet, cash flow statement, and key ratios. I transformed all of that into 223 numerical features for each company every year. So things like return on equity, free cash flow per share, and debt to equity. One important cleaning step that I performed was I removed banks and other financial firms, mostly because their balance sheets are structured so differently that they would just confuse the models. After cleaning, I had 6,449 firm year observations. I trained the model on 6,080 of those and kept the remaining 369 away so I could test it later. Next, I defined exactly what the models had to predict. Every firm year, so that's one company in 1 year, not a separate company, got one of 4 labels based on how its dividends per share changed over the following 2 years. Grow meant that the dividends rose by more than 5%. Maintain means it stayed within plus or minus 5%. Decline means it fell by more than 5%, and remain unpaid is exactly as it sounds. It means that the company paid nothing and kept paying nothing. As you can see, the groups are not balanced at all. Almost 44% of the test observations grew their dividends, 29% declined, about 19% remained unpaid, but only about 8% maintained. Please remember the maintained category. It becomes quite important later when we get to the results. So I tested 3 machine learning models, and they're all built from the same kind of structure, the decision tree. A decision tree is like a flowchart of a yes or no questions. So, for example, is return on equity above, let's say, 10%? That leads step by step to a prediction. It's simple and it's quite easy to understand, but a single tree makes a lot of mistakes. A random forest fixes that by building hundreds of different trees and letting them vote, so majority wins basically, which makes it more stable and a lot more accurate. A boosted tree also builds many trees, kind of like the random forest model, but one at a time, and each new tree concentrates on the mistakes the previous ones made. In other words, it kind of learns from its own errors, I would say. My question was simple. Which of the three models, decision tree, random forest, and boosted tree, works best for Thai dividends? To compare the models fairly, I used a measure called the F1 score, calculated for each category separately. It balances two questions, which sound kind of similar, but they're different. So first, the question of precision. When the model says a dividend will grow, how often is it actually correct? And two, the question of recall. Out of all the companies that really did grow, how many did the model manage to catch? The F1 score combines both into a single number between 0 and 1. 0 means that it is not accurate, and 1 means that it is accurate, basically. It's a much fairer measure than plain accuracy when some categories, such as the maintain category, are much rarer than the other categories. It's not the whole evaluation story, though. I'll come back to that in the limitations. So, here are the results. A quick note on how to read this chart. Each bar is the best F1 score that model achieved for that category across all the configurations I did. So I tested many different versions of each model, and this is basically the best. So a summary of the best performances and just not one single setup. I just wanted to let you know that. So 3 things stand out. First, the boosted tree took the top score in 3 of the 4 categories. So that would be maintain, decline, and remain unpaid. The one exception to this is the grow category, where random forest edged ahead by just 0.1. So 0.71 against 0.7. Second, the remain unpaid was the easiest status to predict. The boosted tree reached 0.79, the highest score in the whole study. Grow and decline both landed around 0.70. And third, you can clearly see the problem category. So that's the maintain category, like I said earlier. Even the best model only managed 0.22. As for the features, using all 223 works best for the maintain and decline categories. But interestingly, that's not for everything. So on the remain unpaid category, smaller sets of 135 and 169 features actually scored highest. So let me just summarize all our findings. 1, the boosted tree was the strongest model overall. It had the top score in 3 of the 4 categories, with random forest just a little bit ahead on the grow category. 2, remain unpaid is the easiest status to predict, which may be because companies that pay no dividends often have a clear financial profile and tend to not change so suddenly. Although my study didn't test that explanation directly, so further testing is required. 3, maintain is the hardest category to predict. The most likely reason for this is that only 8% of the samples fall into that group, so the model simply didn't see enough samples, though proving that would also take more testing. And 4, more information usually helps. Usually. The full set of 223 features gave the best results for most categories, but not all of them. So why could this matter? For investors, especially people who depend on dividends as income, like retirees, a model like this could one day work as an early warning system for dividends cuts and point to companies that are likely to raise their payouts. For analysts, it's about scale. No human can possibly read the financial statements of 515 companies every single year, but a model can flag the ones that are worth a closer look. And for research, this study adds early evidence that tree-based models can find real dividend patterns in emerging markets like Thailand, where tools like this may matter most because far fewer analysts ever cover these companies in emerging markets. One thing I want to be clear about is that this is a research result and not a ready-to-use investing tool, so this is far off from like an actual investing tool. Please don't use this to actually invest. Of course, this study also has its own limits, and I want to be very upfront about them. First, the maintain group may have been too small for the models to learn from properly, as I mentioned earlier. Second, I only use financial statement data. This means that models couldn't see important information such as company news, management decisions, or changes in the wider economy. The study also focused on only one stock market. In addition, I also used a simple train test split. A stronger test would leave out most of the recent years completely. This would show whether the model could truly predict future results without seeing the same companies before. The results should also be compared with a simple baseline model. These limits suggest several areas for our future research, so using stricter time-based testing and baseline comparisons, applying methods that help models learn rare groups such as maintain, testing deep learning models such as LSTMs, which are designed to find patterns over time, adding other types of data such as news sentiment into our model, and repeating the study in other countries to compare developed and emerging markets. So, to sum it up, machine learning and boosted tree in particular can read a company's financial statements and predict its dividend paths with meaningful accuracy in 3 of the 4 categories, even in an emerging market like Thailand. The results are quite promising, but they need stronger validation before anyone should use them for real investment decisions. Thank you very much for listening.